I'd like to welcome you back to the 2021 virtual annual dinner and meeting of the Wharton Private Equity and Venture Capital Association. While we hope and expect to be in person again next year, I feel like we have perfected this virtual craft, including context, format, and specifically the technology platform, where we've received actually countless accolades already for the platform that we're using today, and hopefully you're using it well yourself. My name is Bruce Schulman, Wharton grad class of 99, and chair for the Wharton Private Equity and Venture Capital Association, a 20-year plus organization that represents the over 5,000 Wharton and Penn alum actively investing private capital in transactions and companies. I'm also the former chair of the Wharton Alumni Executive Board, and for my day job, the managing partner at NGP Energy Technology Partners, a 15-year-old private equity fund investing in deals in the environmental, industrial, and energy services space. I'd like to take a minute to thank our sponsors who support this great event. First and foremost, Blue River Partners, part of IQEQ, who for the past 5 years has been a lead sponsor for not only this annual dinner, but also our CIO Summit. And our ongoing corporate sponsors, Morgan Lewis, Triago, and Willis Towers Watson, who collectively have supported us and all of our content for our membership for over 15 years. And we hope that during the networking sessions, you have a chance to meet with our terrific sponsors. I'd also like to thank our annual dinner planning committee. This committee, a group of volunteers, has worked with our Wharton Private Equity Association staff to put on this great program with all the content and all the speakers. And we want to thank them for their tireless efforts in doing that. Now, I've been around for a long time. I've attended nearly every annual dinner for the past 20 years and major event with the likes of distinguished economists, professors, Fortune 500 CEOs, governors, CIOs of the largest foundations and endowments in the world. But to be able to say in one breath that I'm introducing not only a current Federal Reserve Bank president, but also a former chair of the SEC and current chair of Apollo Management is something special to say the least. Neel Kashkari, the current president of the Minnesota Fed and a Wharton alum. Neel's been a great friend of Wharton Private Equity and Venture Capital Association over the years. I actually remember 10 or 12 years ago, as he was leaving the Treasury, when he came and did a small roundtable lunch with us at Wharton Private Equity prior to his time moving out to the West Coast to move on to greater pastures. And Jay Clayton, the former SEC chair and now current chairman of Apollo Management, is a new contact to me. I guess I'm thankful for that in some respects, but is well known in the Penn Law alumni circles. I look forward to hearing their critical insight from the front lines of COVID and the government response, diving into macro, micro, and industry-specific topics in their fireside chat. So without further ado, I turn the mic over to Jay Clayton.
Bruce, thank you. And it's a great pleasure to be here. And well, it's fantastic to have the opportunity to interview Neel. And you touched on a few of the things Neel has done in his career, but to me, it's an amazingly diverse and impactful career. We all know he's now president of one of our regional Federal Reserve banks, which comes with great national and local responsibility at the Minneapolis Fed. But a number of other things in Neel's background are just worth noting because it's so impressive. He started as an aerospace engineer. He became an investment banker. He was Senate confirmed as an assistant secretary of the Treasury. He was overseer of TARP, a California gubernatorial candidate. He's now oversees a very large pension fund, and maybe we'll talk a little bit about that. So I classify Neel as an investor, and he's also a husband and father. In his time at the Minneapolis Fed, one of the things that he's done is focus on opportunity and inclusion. And he's created an Opportunity and Inclusive Growth Institute. And I know he feels passionately about financial inclusion across our economy. So with that as background, let me welcome you, Neel, and really appreciate this opportunity on a personal level and for our friends at Wharton.
Well, thank you, Jay, and thank you to the host for inviting me. And it's really great to be here with you, especially Jay. I'm really eager to learn from you as much as I am to share my own thoughts. But this will be a great conversation, so thank you.
Well, look, let's kick it off, and I want to kick it off with a compliment. I'm going to go in the macro area. Your colleagues at the Fed, together with the Treasury and the CARES Act, where we are today versus 12 months ago with this pandemic, and the fact that our credit markets have functioned, housing prices have been relatively stable, inflation has been stable. If you had told me, and I was nervous, 12, 11 months ago, that would be the outcome in our credit markets, our public capital markets, and we'd have the kind of stable banking system that I'm sure you hoped for when we thought about TARP and Dodd-Frank. Well, hats off to you, and your thoughts.
Well, I think you're exactly right. We are far better off today than I had expected in terms of the economy and in terms of our financial system than I worried about a year ago. In fact, I think it was last April, I wrote an op-ed in the Financial Times arguing that I thought the biggest banks should go out and raise capital because we just don't know how big the losses are ultimately going to be with so many sectors of the economy shutting down, people losing their jobs. They wouldn't be able to pay their credit card bills, their car payments, their mortgage payments. Those losses would then roll up into the financial system and the banking sector. It's turned out so much better for a number of reasons. One is the Fed acted so aggressively last March and April to get liquidity into our financial system. Absolutely the right thing to do, and it was very effective. Number two, Congress, it really surprised me, and how both parties came together very aggressively to support small businesses and to support families who lost their jobs. And that helped families pay those bills, pay those credit card bills and those car payments and those mortgage payments. And that helped the financial system not face losses and be more resilient. And then third, our scientists and our healthcare workers and our experts have done extraordinary work, far exceeding expectations in terms of developing vaccines that are effective in helping us put this pandemic hopefully behind us soon. And so a lot of things have gone right in the face of a 1 in 100-year healthcare crisis.
Yeah, and I just want to say I agree with you. One of the more scary times in my public service career, but also one of the more satisfying times, was that period from, say, late March through April of 2020, when partisanship fell away, and it was let's try to put the pieces in place to make this work, to bridge to where we are today. So switching to where we are today, we've done okay. I know as a regulator, you never want to say it's over because every day is a day of vigilance. But what do you see going forward? The U.S. seems to be in pretty good shape in terms of being able to put social distancing, on a path toward some normalcy, but the rest of the world's a little bit behind. What are some things that you're focusing on?
Yeah, I think you hit it. We are vaccinating, as you all know, 3 million or so Americans a day, which is really positive. We've come a long way there. We still have a long way to go. So it is a race between vaccinating more and more adults and the spread of these variants. This UK variant gets a lot of attention because it's really spreading rapidly in America. And one of the concerning signs is that it appears to be more potent with young people and with children, which was not true in the original strain of the virus. So there's a horse race between vaccinating as many Americans as possible and this other strain, which is now flaring back up in parts of the country. But the fundamentals of the US economy, I think all of that intervention from the Fed, from Congress, has been very effective in keeping the fundamentals of the US economy sound so that once we can really put this pandemic behind us, we can get the US economy hitting on all cylinders again. So I think the outlook is quite positive, but there are still downside risks that we really have to continue to pay attention to.
Yeah, I'm gonna make an observation and see if you agree with it. We have technology. 10 years ago, we would not have been able to convene like this. Things like that have greatly affected positively our ability to continue to function in this new environment. I think the signaling, the price signaling in the American economy due to technological innovation and like is one of the untold stories of how we've managed to get through this pandemic. The ability of people to adjust their behavior, seeing new prices, seeing supply and demand, it to me has been really remarkable. I don't know if you've thought that way or not, but harken back to 20 years ago, how we looked for pockets where investment was needed or capital was needed or labor was needed. It was much harder to signal across the economy.
Well, I think that one way of saying the same thing you said is just the information flow in our economy and the seamlessness with which information can flow, whether it's a conversation like that or those price signals that you were just speaking about. I think that's absolutely right. I mean, I think when historians look back on this period, I think the innovation engine of the U.S. economy, both in terms of the technology that we're using right now and in terms of the healthcare technology, vaccines and treatments, I think it's going to be an extraordinary example of the power of innovation and the importance of innovation in helping us drive economic competitiveness and ultimately success for all of our fellow Americans.
Yeah, look, that's really well said. Should we face something like this again, I hope we have the muscle memory that we've learned from this time. And one of the things I want to just bring us back to is 2008. You developed a lot of muscle memory because you were there for the architecture of TARP stabilizing, and then the architecture of what I would say is hardening the core of the banking system. How has that helped you, that experience on the front lines, do your job today?
It's helped me personally tremendously. I mean, it gave me confidence that we'll get through this. Having been through '08 and seen how scary '08 was, I knew that we would get through this. The question was how many lives would be lost, and very sadly, still 500,000 Americans have already died. We should never forget that. And how much economic hardship is going to be caused by this pandemic. But that gave me confidence. Second of all, if you look at the Federal Reserve, we all benefited tremendously from the work that the Federal Reserve did in '08 and '09. And we took that knowledge and we acted much more aggressively in this crisis because we had the benefit of having that experience before. And that I applaud all of my colleagues around the Federal Reserve for that. And another thing I think Congress also learned that I spoke about a lot at the beginning of this pandemic, one of the things I learned in '08 is we were trying to be too targeted in some of our response, for example, to homeowners. And I think hindsight has shown us we would have been better off if we were more generous, less targeted. And I think Congress learned that and got that message, and they were very aggressive. And they said, you know what, it's better to get some assistance out to people who don't need it than to miss people who do need it. And so err on the side of being generous. I think that lesson was also carried forward from '08 to 2020. And I think that served us all very well.
I couldn't agree more with you. When housing prices fell out of bed and consumer confidence dropped, we lost the consumer in the economy. This time around, we really didn't lose the consumer in the economy, which was so important.
Yeah.
So terrific job. So look, it's venture capital and private equity. I want to switch to that. So I believe, let me just set this out, that one of the key comparative advantages for the United States in the global economy is our venture capital and private equity markets. Very nimble markets where you can throw capital at innovation. People are willing to put capital at risk. I can tell you that when I used to sit in meetings with my fellow regulators around the globe, there was envy because it is such a growth engine. Your thoughts about the importance of venture capital and private equity to the U.S. economy?
Well, I couldn't agree more. It's a huge competitive edge. And I just go back to the innovation economy. Why is it that the U.S. economy is able to innovate in so many different dimensions? And we frankly don't have competitors. I mean, of course, other countries innovate too, but there's no close second in terms of competing with America on innovation. And I think that is completely enabled by our venture capital and our private equity markets. Those are key contributors, as are universities. I mean, it's not just about private equity and venture capital, but they play a very important role. And my perspective on this is it's interesting. It has changed a little bit since I've come to the Fed. Before I came to the Fed, I had worked at PIMCO, and I would go meet with, we would go pitch pension plans as an example, a source of private capital. Well, the Federal Reserve has a pension plan, about $22 billion. And I sit on the committee that oversees the pension plan. We have a world-class professional staff that manages it. And then a few governors and Fed presidents sit on the committee that oversees it. And we make between $300 or $400 million of private equity allocations a year, up to a 5% of our $22 billion. So that has given me a different perspective on private equity as a source of return, not just a source of innovation capital and private investment capital. And I just think it's a very interesting space, and would love to get your take on it, both as a regulator and now that you're at Apollo.
Well, look, I'm a big believer in our public capital markets. An amazing invention of sort of the modern American economy, because in our public capital markets, people who are saving for their retirement on their own get to sit side by side in the same investment at an incredibly low cost with the most professional, PIMCO and others, the professional investors. Incredible. But there's a number of structural issues that are there to create that kind of market that mean, as a practical matter, you really have to be a pretty darn large company for it to make sense. Whether the numbers 500 million, a billion, 2 billion, there is a threshold below which it doesn't make a lot of sense to be a public company from a structural perspective. So that's number one. Number two is there are a number of things in a private company that you can do, including, let's just be frank, managing for a 2, 3, 4-year time horizon that are difficult to do in a public company with quarterly reporting. Doesn't mean we should get rid of quarterly reporting. Quarterly reporting is incredibly important, but the public investor is one that may need to get in and out quarter to quarter, where the private investor is in for a long time. Those two things means that we can't have a one-size-fits-all market. So private equity and venture, they fill that space, and I think they fill it incredibly well. From an investor standpoint, they're not completely correlated. In fact, a balance of public company investments, private investments is far superior from sort of a volatility point of view over an investment horizon than just one or the other. So look, I could go on about this for hours, but I want to hear more from you. But you touched a nerve.
Well, this is a great topic because this is a conversation I have with our professional staff. So part of my new insight now, sitting overseeing a pension plan, is I'll ask them. I'll say, well, if we've invested in 30 funds, and we started investing in private equity in 2014, and each of those underlying funds has 20, 50 underlying investments. Now we have hundreds of underlying investments, and I say to them, boy, it feels to me like that's just the S&P. So why isn't that just a levered S&P return? And we're paying high fees for a levered S&P return. And they push back and say, no, there are these structural inefficiencies that continue to exist that the public capital markets can't capture. And so, as an academic matter or as a theoretical matter, I'm very fascinated by, why is it that our public capital markets are incapable of addressing some of these inefficiencies and squeezing them out, and only private equity is able to step in. As a fiduciary, I want to go after high risk adjusted returns. So I'm happy we're participating in private equity, but as a taxpayer, as an American citizen, I'm wondering, what is it about our public capital markets that enables these inefficiencies to continue to be created?
Well, look, safeguards are not free. Okay, there's a lot of safeguards and they're legal safeguards, but they're also cultural safeguards. Public companies generally don't swing for the fences, knowing that they may fail. Private companies and venture companies can do that all the time. Venture investors understand that some of their investments are going to be a zero. Some large portion of them may be a zero. We don't have that kind of cultural attitude about our public capital markets. Probably right. That's a big part of it. And another part of it is liquidity is not free. Providing people daily liquidity is a different approach from providing people with liquidity on a 3, 5, 7 year basis, which allows you to make a much longer bet on a particular strategy. And
That's right.
That's okay. I think I'm like you. Should we try to make one better? Meld the two together or something? Probably not. It's okay to have those two different approaches in my view.
That makes sense.
Yeah. No, look. My issue is, how do I get retail investors access to a portfolio like your pension fund? How do we get them 10% exposure to these longer dated investments? So that's one of the things that I think we should continue to think about. All right, look, let's go to that's kind of the good news. Let's talk about some bad news. You went through what I would say once and I hope in a generation crisis, where we really had pockets of risk we didn't recognize and incredible liquidity mismatches. Are there any pockets of risk in our financial system that you see today, or liquidity mismatches that we ought to be addressing, or things that keep you up at night?
Well, I was taught that the '08 crisis was a once in a lifetime event. And so I was shocked when 12 years later, essentially the Federal Reserve had to back up the US financial system once again. It's not supposed to happen every 12 years. And someone will say, well, this was different. It was a pandemic. I agree. But if once every 100 years we have a housing downturn, and once every 100 years we have a pandemic, and once every 100 years we have a terrorist event, pretty soon we're talking about a once every 10 or 20 year event, which feels way too frequent for me. And I think we saw last March and April that the regulatory reforms after '08 are incomplete. And it really is about liquidity mismatch. It really is about, we saw the short-term funding markets come under enormous pressure last March and April, and required the Federal Reserve to provide that liquidity backstop. So I hope that we seize this moment to learn from this most recent episode, look at what reforms were done in '08 and take them forward and say, let's complete the work to make sure that our financial system is more resilient. And of course, the lender of last resort, we are designed to be there. That's why we were created as the Federal Reserve. But the question is, how frequently should you need to hit that lender of last resort? I think once every 10 years is too frequent. I think the American economy deserves better.
Yeah. No, how do we say it? There is no system that you can put in place it doesn't need a refresh. Right? I mean, I think that what we learned, at least what I learned, and your comments, please, is just how interconnected our economy is to our short-term funding markets.
Yes.
They are the lubricant for just about everything at the end of the day. And I think when they started to seize up, I got nervous. So I'm sure that's an area of attention. I know I don't want to do to you what people would do to me, which is ask some question about what you're thinking when you're not ready to say it. I'll ask it this way. I think one of the areas that our central bankers in the U.S. and around the globe should focus on are those short-term funding markets, and how resilient are they, and additional safeguards that need to be put in place. So do you agree?
100%, absolutely.
Okay. All right, well, super. So look, let's tie that to what we're talking about here today. And Bruce mentioned this, and I don't want to feel like I'm now a rah-rah champion for the industry, but I do like that the liquidity mismatch, it's not really there in the private equity industry, where you're taking money for the long term on the investing side and to put it into longer term investments, as opposed to taking money with the promise of immediate or near term liquidity that is then in longer term investments. So as we pushed those long term investments out of the banking system, and because of the liquidity profile that banks provide, I believe pushing them into private equity type vehicles is de-risking. I'm not sure that pushing them into hedge funds with their liquidity and leverage needs is de-risking. But could you comment generally on that, Neel?
Well, I think you hit the nail on the head. That is the most common source of financial instability comes from liquidity mismatches, whether it's those short-term funding markets, whether it's mutual funds, which are really safe most of the time, and maybe their underlying investments are safe, but when a shock hits the economy and fear grips the markets, people grab for liquidity wherever they can get it. And then sometimes you'll see them starting to sell mutual funds that are otherwise very healthy and sound, but because they provide daily liquidity, they are an outlet. And so it is that liquidity mismatch. And so I agree with you. I don't look at private equity and venture capital as a source of financial instability simply because they do a better job than most of providing that matching of their investment duration with the liquidity that they're providing that their investors. And if there were hedge funds that had similar multi-year lockups, then in theory, they may be somewhat similar in terms of their safety, but I don't think they lock up their funds the way private equity and venture capital do. And so I think we should be looking at all of these different asset classes and saying, where are there inherent liquidity mismatches? I mean, the money market mutual funds is a clear liquidity mismatch problem. That's part of a source of their riskiness. It was in 2008. It was again in 2020. And then we saw, why were U.S. Treasury bonds coming under pressure last March? It wasn't because people were worried about the credit risk of the United States. It's because funds that owned a lot of Treasury bonds were getting redemptions because they could provide that liquidity. And so people had to sell whatever they could sell. And so I just think that these issues are just enormously important. And we need to look at all of these markets for these liquidity mismatches because they are such a source of vulnerability.
Yeah, I have to say that was kind of it took me a moment, sort of a head scratching moment to say, why are the treasuries under pressure? People are selling their most liquid securities. Well, they're selling the most liquid securities because they had to take the shortest, the most minimal mark. It was amazing to watch the most secure asset class come under that kind of pressure. I don't know if it surprised me a bit. I don't know.
For sure. That was one thing that was very different from 2008, because in 2008, people ran the treasuries as a source of safety. Here, they still wanted that safety, but the fear of this pandemic was so unusual. People had no idea. I didn't have any idea. How bad was it going to be? How deadly was this virus? How contagious was it? How widespread would sectors of the American economy shut down? So in those moments of March of last year, people said, you know what? I don't want stocks. I don't want bonds. I don't want treasury bonds. I don't want bills. I just want cash. Mm-hmm. And then when you have everybody running the cash, it creates tremendous strains throughout the financial system. And that's when the lender of last resort, the central bank, must step up and provide massive liquidity. And I think the Federal Reserve did that appropriately and aggressively and effectively.
I agree. So again, switching gears, using cash to switch gears, digital assets. Let's take a broad category: fintech, digitization. But we'll start with digital assets. Any particular views on digital assets? And I will say, sovereign sponsored, at the one end of the spectrum, a digital dollar or a sovereign recognized stable coin, all the way to private sector digital assets. Your thoughts?
Well, let me just start by saying I'm very pro financial innovation. So fintechs in general, coming up with innovative products and technologies, wonderful. The regulatory system probably is going to need to innovate to catch up with them, but pro innovation. I'm so far very skeptical of all of these digital coins, Bitcoin, et cetera, in terms of being a credible replacement to fiat currency, the dollar, the euro, the yen. And there's so much hype and there's so much confusion. What is a digital asset? I could send you $10 right now via PayPal or Zelle. That's a digital dollar. So when people say, well, no, the central bank should offer a digital currency, most people who say that, with all due respect, I don't even think they know what they mean by that. Does that mean that you and I should each have an account at the Federal Reserve and the Federal Reserve should offer retail accounts? In theory, we could do that. I'm not sure what the advantage is. And so I saw this week the Bank of China announced that they're going to offer a digital renminbi. I'm still not even sure what that means and what capability they will have or their users will have that they don't have today with Alipay. So for me, right now, it's mostly hype. but we should study it and keep our mind open. And I'd love to get your thoughts on it.
Well, another thing that has my, sort of my mind evolving and spinning a bit because, well, let's talk about China. Having that sort of digital RMB is really an amazing piece of control that a government has over its citizens.
Correct.
Monitoring transactions, the ability to tax immediately, are just two of the things that you get with a digital sovereign currency. And I think, people need to think long and hard about whether a switch to that kind of information flow and control to a central bank or a central government is really where we want to be. So that's just one aspect of it. In terms of sort of what I'll say is the private stores of value, private means of payment. I have to say, frankly, I'm surprised. If you had asked me 4 years ago, would we have had this much attention and this many people who are what I would say is credible investors participating in sort of that private space? I would have said no. But this recent search for sort of an alternative store of value to protect against inflation or whatever it is, from a purely academic economist point of view, it's fascinating to me.
Yeah, I mean, it's fascinating, but here's the Achilles heel that I've seen so far. Bitcoin enthusiasts will say, look, there's only going to be so many Bitcoin that'll ever be printed or mined by design of the algorithm. It can never be more than that. And that's true. But the barrier to entry to anybody else creating a copycat is zero. So there have been thousands of these coins that have been created. And if I could go in my basement and create a new metal that looked exactly like gold, had all the same properties of gold, I would have effectively created gold, even if I called it something different. And then the value of the original gold would diminish. As you know, in American history, there was a time when each state had its own currency, different banks had their own currencies, and you had massive inflation by proliferation of currencies. That's the current state we're in these alternative private coins. So unless there's some way of weeding those out and you just have one or two, I don't see them as being a credible competitor to either the dollar, the euro, or the yen. I mean, maybe for Zimbabwe or some country with runaway inflation, hyperinflation, maybe there, but I just don't see it in advanced economies. But let's keep our minds open and see what happens.
Yeah, and I do think regulation, big enough space, big enough participants, regulation needs to continue to come to this space. It can't be terrorist finance, can't be AML evasion,
Right.
Those types of things. We've done so well to make our financial system credible in that regard, in that it's not the instances where you have financing of illicit activities, money laundering, and the like are very small and should be getting smaller with technology. We don't need an end run around that. That's just my view.
No, but it's so important that you said that, because the strongest proponents of some of these actually say, well, this is a tool for anonymity. And as you pointed out in the Chinese case, it actually is the opposite of anonymity. It gives the state much more visibility and control. So my economists have said, one thing we could do if the Fed offered a true Fed digital currency is we could deliver negative interest rates that we really can't do today. Well, that's interesting. But as a customer, negative interest rates, more information for the government to see where I'm transacting, immediate taxation from the government, none of these things are in my interest. So it isn't obvious to me what the use case is from a user's perspective. I get what the use case is from a government control perspective.
Yeah, I agree with you. And look, maybe payment efficiency. Maybe we bring down the cost of payments, domestic and internationally. But there are ways to do that. Yeah. But look, let me shift. We're getting some questions in the chat, and I want to make sure I give the audience an opportunity here. Bruce had a question, which is, do we have an asset bubble in the stock market? I'll jump in for Neel and say, current regulators never talk about whether prices are too high or too low. It's a market, but our market's overheated. Do you worry about cheap capital? Look, I'll say to Neel, okay, asset inflation. Let's not talk about asset inflation. What are your thoughts on the pros and cons of asset inflation as a result of loose money?
Well, a lot of people will say, look, it's the Fed doing this. The Fed is between quantitative easing and low interest rates. We're pushing people into all these asset markets. And I will push back a little bit and say the following. We think a lot about what is the neutral rate of interest, what interest rate balances savings and investment. And we believe, and I think most economists believe, that neutral interest rate has been declining over the last 30 years due to broad macroeconomic forces such as technology development, trade, demographics, the aging of society. Well, what do we do then as a central bank? We look at the neutral rate and we move interest rates up and down around that trend to achieve our dual mandate of stable prices and maximum employment. But we don't set that trend. So if we're right that we are in a low neutral rate environment because of these broader macroeconomic forces, you would expect all asset markets to then incorporate that low neutral rate environment. So that itself, a low neutral rate environment, would lead to higher asset prices than if you were in a higher neutral rate environment. So part of it, I believe, is driven by economic fundamentals of where long-term interest rates are going because of these macroeconomic forces. Last thing I'll say, I mean, we could go on for this for an hour. Back in 1996, Alan Greenspan declared irrational exuberance for the stock market. And then the stock market climbed for the next 4 years. And as you know, the bubble burst in 2000, 2001, leading to a fairly mild recession. My opinion is if the Federal Reserve in 1996 said there's a bubble in the stock market, we're going to raise rates to keep the stock market from climbing any higher, I think the recession that would have caused would have been deeper than the recession that followed when the bubble finally burst. So I look at this through the lens of what are our policy levers, what are our trade-offs, and trying to lean against these stock prices actually can be very costly to the American people in terms of jobs, wages, and employment. So
let me say we should talk more often because I sure agree with you a lot. Maybe that's boring, but the effect on the what I would say is the neutral rate, the natural rate of innovation and technology. I think we underestimated it for the last 2 decades. We, as in public observers, the amount of efficiencies added by technology were, I think, significantly underestimated, and their effect on what I would say is natural interest rates. I think that's what you're saying there.
Well, I mean, let's say this, if productivity is being mismeasured and productivity is actually higher than we think, or than is being reported, then the other things move along with that. Then inflation is even lower than we think. And then then it means, well, why are we raising interest rates? So we adjust interest rates, and that includes the federal funds rate, and we use our balance sheet as a monetary policy tool to try to achieve our dual mandate of stable prices, average of 2% inflation, and maximum employment, as many Americans are working as possible. For the last 10 years, we've had inflation below our target, and we've had some slack in the labor market. So we've been undershooting on both dimensions, which tells me that monetary policy has been too tight over the last 10 years, not too loose. And so these are complicated issues, but just saying, well, we see asset prices are high, what does that mean for the Fed? It's very complicated, and we have to be very careful before we would say, well, we're going to say that the stock market's too high, so we're going to do something different with monetary policy.
Yeah, and I'll just add one more thing, see if you agree, which is people look at the rise in asset prices, and they have a fiscal monetary policy domestic view. But when you have equities where 50% of the revenues of those companies come from outside the United States, with emerging market growth and the like, you're going to have asset prices that rise much faster than those domestic indicators would indicate. I mean, that's I think something that we don't all have our head around when we look historically, where 70, 80, 90% of the revenues in the S&P 500 came from inside the United States.
I think that's a great point. And a related point, obviously investors have the option to invest around the world. So interest rate markets are not completely independent of each other. They are also have linkages. Inflation also tends to be a global phenomenon as well. So when we've seen periods of high inflation in the past, 30, 40 years ago. That was happening in advanced economies around the world. And now advanced economies for the last decade or so have had very low inflation around the world. And so these forces are bigger than just what the FOMC is doing or just what the ECB is doing.
Yeah, well said. Let me get a couple more questions out of the chat here, which is, speaking of the ECB, another segue. They are not shy about buying corporate debt on their balance sheet. Our friends in Japan have not been shy about buying both corporate debt and corporate equities. Do you ever see the Fed venturing what I would say is further up the risk curve in terms of asset purchases?
Well, not if we can avoid it, certainly. I mean, in the last year during the pandemic and the depth of the pandemic, credit markets were freezing up, and we did launch corporate bond facilities. There we said we're just going to buy against an index so that we're not picking winners and losers. We're not playing politics. We just want to provide liquidity to the market. That was important because I'll give you an example. So we know that travel and housing and service sectors got hammered last year and are still suffering right now. But if blue chip industrial companies whose businesses were sound could not access funding in the capital markets, then this healthcare crisis that targeted the service sectors of the economy would spill over and potentially shut down much broader sectors of the economy that were fundamentally sound, fundamentally very healthy. That's why the Federal Reserve stepped in, and we ended up not having to buy very much. Just our announcement effect, our presence, helped provide liquidity to those markets. So we did do it in an emergency. We don't see it as part of our normal course of operating monetary policy. We think between interest rates, our traditional quantitative easing, buying treasury bonds and Fannie and Freddie mortgage-backed securities, we think that those tools are powerful enough to provide the economic stimulus that the economy needs.
Look, that's really well said, and I agree with you. I think the actions of saying we're standing by, and then the liquidity provision allowed the private sector to provide liquidity in those markets, and companies that needed, almost all healthy companies or relatively healthy companies that needed to term out their debt were able to do so with private sector funding, because everyone knew that if it got really bad, you were there.
Exactly. So it worked exactly as we hoped it would work, which we're really happy about.
No, great. Look, great job. I think we're coming to the end of our period here, and I'm gonna turn it over to Mike in a second. But Neel, this went by in a huge hurry, just because it's such a great conversation. And for myself and everybody here at the forum, just thank you for giving us your very valuable time.
Well, thank you, Jay. This was a great opportunity for me and so much fun for us to get to do this together. I really appreciate you taking the time out of your busy schedule as well.
Thank you. Mike, over to you?
Thanks, Jay. Appreciate it. And then thank you, Neel, as well. That was quite a commentary, and I'm sure that myself, including the audience, got a lot of information that they can walk away with. I'd like to take a second to introduce myself. I'm Mike Purse, the head of tax for Blue River Partners, a part of IQEQ. We are a proud long-term sponsor of this annual forum, as well as the CIO Summit, and we look forward to being involved in the future as well. Up next, the investment theme roundtable discussions will take place. You can take a quick stretch, grab a cocktail, depending on your time zone. But once we wrap up with this presentation, it will take place in the general ballroom. We've added the topics on the first floor for investment industry meetups. On the second floor, you'll have the investment issue discussions, two being led by Blue River Partners around debt fundraising and due diligence. And on the third floor, you'll have the chance to meet up with your classmates by year. If there's a topic you'd like to see addressed, please feel free to add it in the chat. And you can always head over to the welcome table or help desk with any questions. Thanks, everybody, for your time, and we'll see you in just a moment.